Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It is lecture time, and this week's topic is a topic that I've been getting for years now, and I haven't really done an in-depth lecture on this topic, so I thought this would be a good time to do it. We're going to talk about investing long-term. We're going to talk about hedge funds. We're going to talk about registered investment advisors. We're going to talk about all of those things. So a little while back, I did a lecture on why hedge funds are a scam. Well, today's topic basically is why you should never, ever invest in a hedge fund. So that one was more of a shorter 10 or 15 minute video. Well, this is a full-on 1 hour lecture about why you shouldn't invest with hedge funds, as well as where you should be putting your money, how you should be investing for the long term. So a lot of what we do at Live Traders is talk about intraday trading on 2-minute charts, 15-minute charts, daily charts. We'll talk a little bit about swing trading, even a little bit about core trading. But today we're talking about long-term investments, how you can retire wealthy, how you can retire beating what most people are doing. Here's a stat that many of you probably didn't even know. Over the last 10 years, the market has averaged a 15.2% compounded return. Okay, compounded, and yet the average investor has gotten 2.9% compounded over that same period of time. All of you out there trying to time the market, beat the market with your long-term 20, 30, 40-year portfolios, you're doing a terrible job of it. Not all of you, but most of you. The statistics don't lie, and that includes over 95% of hedge funds out there underperforming the market. So today's lecture is very powerful and important for those of you that are long-term investing, not necessarily trading. Now again, we trade is income producing, okay? Swing trading is wealth producing. Well, investing, that's how you retire rich. So take some of those profits from your intraday trading and put them into your long-term portfolio. So again, today's topic is going to be more about how to build wealth, why you shouldn't invest in hedge funds, and how you can at least at 40, 50, 60-year-old retire with 7 figures or more. It's very powerful and yet so simple at the same time, all right? If you like these videos, please click the like button. Also, if you like the channel, please smash, hammer, crash that subscribe button. I am Jared Wesley of Live Traders. Let's get to it. Today's topic, guys, is why hedge funds are a scam. I told you guys it would be a little bit different today, and it is a little bit different. I've been getting a lot of comments from folks about wealth building. How can I build wealth? And this topic came up in terms of, should I invest in a hedge fund? Should I use a registered investment advisor, an RIA? Should I use a wealth manager? Should I just buy an ETF? Or what should I do? So I thought this was an appropriate topic for folks because, well, a lot of this type of education is just not out there, to be honest with you. You know, schools don't teach it. There's no real personal finance courses. So I thought today would be a good time to talk about that stuff. All right, so let's talk about it. But before we do, we have to get our weekly installment, our weekly fix of when will the insanity stop? All right, when will the insanity stop? I have a couple this week. I actually had 3 or 4, but I'm just limited it to 2 this week. All right, so this one is very, very, very interesting to me. All right, so this is a person who traded GNUS, G-N-U-S, okay? On June 9th, I bought 4,300 shares of this company, for $4.25. You got to love how the person starts off. They must obviously not have felt that way when they first bought this company on June 9th, because they probably wouldn't have used that word twice. All right, but nonetheless, they were up $5,000, give or take. Okay, and then for the first time today, I just made a small purchase to reduce my effing price. I couldn't have much money to inject for these thieves, so now I end up with 5,080 shares at the price of $3.85. This certainly sounds like a millennial to me, because that victim mentality is just running through this person's veins right now. Okay, I will pray to God still hard every day to review my price before the huge dilution that I know will occur. Wow, this sounds like a person who's really on the up and up. Okay, long story short, as of yesterday, because I haven't checked today, this stock was at $1.62. So from $3.85 down to $1.62 with 5,080 shares. So they were up $5,000 and now they're down $11,356 as of yesterday. Okay. Cost averaging down on a losing garbage position is not something that you ever want to do. It's just stupid. It's dumb. It's ridiculous. Okay. Look at this stock, guys. It went from, I don't know, $1 all the way up to $12. And this person thought, ooh, let's buy the pullback. Guys, what's the first rule in Fight Club? I'm kidding. But what's one of the biggest rules at Live Traders? We never, ever buy the first pullback after a climactic sell setup. It's right out of professional trading strategies. We never buy the first buy setup after a climactic sell setup. If this person had taken professional trading strategies, well, he wouldn't be down $11,356 for multiple reasons. One, he would have never bought this buy setup. And two, he would have had a stop loss in place. But instead, now he's praying to God still hard every single day. Okay? And Ice Cube's like, come on, man, right? This is ridiculousness. This is why this is part of when will the insanity stop? Because people do stupid things, and there's just no end to the level of stupidity that people do. It's unbelievable, okay? But we can go one step further. This one, maybe not as bad in dollar terms, but it's just as bad in thought process, okay? It's just as bad in thought process, okay? This time we have Jackie Chan telling us, all right, my gut tells me to hold. So somebody sent me an email. Time is money. Sent this on August 7th, 4:04 p.m., right? I need your help. I need your insights on what to do next from this point forward, okay? If you could spend, you ready, guys? If you could spend at least 1 minute on each stock to see what I should do, I can compensate you via PayPal. Okay, these are real emails. I kid you not. People send me this shit, okay? My gut tells me to hold. One, if not all three, is going to jump. I mean, are you shitting me? I mean, even Jackie Chan's like, what the what? And he doesn't even speak English, and he's like, what the what? All right? These are the types of emails people send. My gut tells me to hold. One, if not all three, is going to jump. By the way, take a look at the cash equivalents. I mean, I don't trade options and other things, but this guy's not doing terribly well. But his gut tells him it's going to jump. My gut tells me go to the beer store, right? I mean, come on, man. If you could spend at least 1 minute on each, just 1 minute on each stock and tell me what I should do. So you don't know me from Adam, okay? Maybe I'm just super salty, Rachel, and maybe I'm extra vindictive, and I just give you the opposite of what I'm really thinking. Maybe I just come out and say, yeah, buy more. I mean, seriously, you're going to listen to advice of somebody you don't even really know, not sure why you would entirely trust, on money. Crazy. Unbelievable. So I thought these two were kind of funny this week, but this is real stuff. Like, let's go back to the serious point for a second here. People are doing these things every day, guys. Like, on a serious note, people are doing this stuff every day. So personal finance is a very big thing. But the first thing you always have to do is what? Control risk. It doesn't matter what the investment is. Control your risk. Know what is at risk so that you can control that risk. Money management is really that important. Okay? I know, right? Sounds like an easy way to make some money. I just PayPal and buy more. I'm kidding, guys. So that's this week's installment of When Will the Insanity Stop? Now it's time to get serious. Why hedge funds are a scam. All right? And the funny thing is there's nothing funny about this. That's the funniest part about today's lecture. There's really nothing funny about it. Okay? It's all very serious. But everybody knows who this is, right? Is there really anybody in here that doesn't know who this is? All right, I'm assuming that everybody knows who this is. And if you don't, well, you don't watch much TV. Okay? It's George Washington. Let's take the statue down. I'm kidding. All right? So Bobby Axelrod is probably something that everybody knows. All right? Or someone that everybody knows. But here's the question. Can you name these people? And my gut, sorry, no pun intended, my gut says, unless you're in the industry, you're not going to be able to name more than one or two people on the next page. You might recognize a couple faces, but I bet you can't name all 6 or 7 people on here. Now, who are these assholes? Oh, sorry for the language. Who are these people? All right? Who are these people? You can probably venture to guess by the title, hedge funds are a scam, that these are hedge fund managers, okay? Somebody says some random white people. That's nice, all right? I bet you guys could name maybe 2 of these people on here, all right? Seriously, everybody knows Ray Dalio, right? Stephen Cohen, but I bet you don't know these other guys. All right. And the funny thing is, I'm going to show you a list in a couple minutes. And Stephen Cohen's not even on it. I put him in here just as a token because everybody knows who he is. But so far, all your comments, you guys have 1 right. Tate Thompson got 1 right. You guys don't even know who these people are. And that's exactly right, Kevin. And that's the way they want it. But they're some of the wealthiest people on the planet. And they make more than just about anybody on the planet outside of maybe the 20 wealthiest people in the world, okay? And guess what? They live like this, all right? You have to give that a second because the graphics are big. And I thought, that's not bad, but that's really not that great of a picture because if you think that's nice and you think the property looks good, this is what it really looks like. Wait for it. That's what it really looks like. Give it a second. The graphic will come up. That's somebody's house, one of their residences, okay? So I want to go through this just real briefly. We're not going to spend a lot of time on it, but yep, that's a 35,000 square foot, wait for it, addition. 35,000 square foot addition they added to their house, okay? I know, what is that? What is that purple swirl? It's probably some overpriced piece of art, okay? Now, they live like that. They generally tend to fly like that, okay? And wait, like that, right? Kind of the crappy lifestyle, even though that's not one of those people in there. They tend to sail like this, right? They tend to have boats that look somewhere like that or something similar to that. I think Ray Dalio is a $100 million yacht, something like that, a cheap one, right? Okay. And the question then becomes is, how do they afford all this shit, right? How in the world do these guys afford all this stuff? Well, that's how they afford it. Those are the names of everybody on that list except for Stephen Cohen. He didn't make the top 5 or 6, okay? James Simon was the guy in the middle, the older guy in the middle. Ray Dalio was the bottom right corner, okay? You guys don't even know who most of these people are, do you? Look how much they made in 2018. 1 year income, 2018. 2018, okay? Now remember, guys, 2019 was a better year for the stock market than 2018. The market was up like 31% last year, okay? 2018, the market actually sucked, right? The market was down like 4%. $1.6 billion, $1.2 billion, 870 million, 770, 600. This is what the top 6 guys made, 7 guys, whatever it is, okay? And that was in a down year in the markets. That's why I chose that year. That was a down year in the markets, okay? So, let's get to the real stats, the important stuff. Over the past 15 years, 92% of hedge funds under, there you go, Jared, if you could spell, let's fix that. There we go. Underperformed the market, all right? 92% of funds underperform the market average. So how do they afford all those nice things? How in the world can these guys be this pathetic, seriously pathetic, and make that kind of money? How do they do it? I just wanted to put this up there just so you think I didn't pull that graphic out of thin air. Okay? Active fund managers trail the S&P 500 for the 9th year in a row in triumph for indexing. Okay? Active managers who claim that they would do better during periods of heightened volatility are going to have to find another argument. All right? Why did I choose this? Because 2018 was a down year. Hedge funds typically pitch to people, we do better in volatile markets. We do better in down markets. That's generally what their pitch is, right? But after 10 years, 85% of large cap funds underperform the S&P. And after 15 years, nearly 92% are trailing. Okay? How do they do it? How in the world do they have those jets, those houses, those cars? Fees. Fat fees. Okay? Fees. Now, I don't know about you guys, but as a trader, fees are the enemy, right? Nobody wants to pay ECN routing fees. Nobody wants to pay a platform fee. Nobody wants to pay commissions. Nobody wants to pay those things. Why? Because they eat into your profits. Anytime you have to pay money out for fees, it's taking away from your bottom line, right? It's taking away from making more money. So you ask yourself, why would you want to pay exorbitant fees? Well, the idea behind paying fees is what? Outperformance. That's the goal, correct? Outperformance. Somebody is pitching you, selling you on the idea that our hedge fund is going to outperform the market. Let me rephrase that. Our hedge fund is going to outperform our benchmark. Our benchmark, okay? Because that's really what they compare themselves to, their benchmark, okay? So you look at this and you say to yourself, well, do hedge funds really outperform? Not the market, right? Not the market. So the average hedge fund, guys, charges a management fee of between 1.5% flat principal every year and 17% performance fee, right? It used to be 2 and 20. You guys have heard those before, right? 2 and 20, 2% of principal, 20% of the earnings they make. Now think about that for a second, okay? The reason these fees are coming down is because of pressure, right? They used to be 2 and 20, and some of the big funds are more than that. 3, some of the biggest funds take 40-some%, and some of them are worth it, but we'll get into that later, all right? So these fees are coming down because people are seeing through or seeing behind the curtain, right? This is like the Wizard of Oz. What's really behind the curtain? BS is what's behind the curtain. Garbage is what's behind the curtain, okay? So let's keep going. We'll get to the big one. This is the important one. So I used $1 million. Now remember, you can use 100,000, you can use 10,000, you can use 1,000. Just take zeros off, okay? Take zeros off. But if you invested $1 million in the market in 2009, all right, it's about 11 years, okay? And you used a hedge fund with 2% fees and 20% earnings fee, you would have paid them $935,304.42 in fees over that 11-year period. 900 grand in fees. And remember, that assumes they even got the market average. Remember, 92% of hedge funds underperform the market. 92% underperform. So I'm giving them the benefit of the doubt that they actually got the market performance. I'm giving them the benefit of the doubt, even though we know 92% of them don't meet this metric. Over the last 11 years, the market has been on an absolute tear, an all-out tear, one of the best 10, 11-year periods in the history of the market. Got to be in the top 3 or 4. A 15.2% compounded return over that time. You paid 900 grand in fees, and your net total after paying your lovely hedge funds just so Ray Dalio could have his bigger boat is 2.7 million. So some people are going, oh, hey, that's not bad. You know, I made 2.5 times my money. That's not bad. We'll get to the rest later. I just want you to burn that into your head right now. 935,000 in fees. So you say to yourself, all right, hedge funds suck, right? So that's your initial thought. Wow, I didn't realize they were that expensive, right? I didn't realize that so few of them actually beat the market. Yeah. And yeah, they're expensive and very few of them beat the market. I'm going to get, Robert, to the top 8% in a minute. Okay, I'm going to get to that in a minute. All right. So what about registered investment advisors? What about wealth managers? That's the hot topic lately, right? It is. It's a hot topic lately. Registered investment advisors, what RIA means for those of you who don't know. Okay. Well, what about those guys and gals? Well, on average, they charge about 1 to 1.5%. I gave them the benefit of the doubt and we made it 1.25. To be honest, the average is 1.65, okay? You would have paid those guys $285,000 All right. $285,000 in fees over the last 11 years. Okay, that's a rental property just for fees. And remember, very few of them outperform the market also. All right, 95%. I don't think I have the statistic in here. I'll have to put it in. 95% of registered investment advisors underperform the market also. So I'm giving them the benefit of the doubt that they got the 15.24% return, and they charged you 1.25% to do it. Now, to be fair, registered investment advisors, wealth managers, the more money you have, the smaller the fee is. If you have tens of millions, hundreds of millions of dollars, that fee is going to be like 0.3, 0.4, 0.5%. If you have like 50 grand, 100 grand, you're going to be in the 1 to 1.5, maybe even as high as 2% range. Okay? 285 grand. So we're moving in the right direction, aren't we? We're moving in the right direction. All right? It's not 900 grand, it's 285 grand, but it's still not what it needs to be. All right? So, assets under management is AUM, assets under management. So this is really the total fees that they charge. I want to go to the next graphic. But the point simply is you can see right here, the more money you give them, the lower the fee is, right? So if you give them $10 million versus 200 grand, you're going to get a better deal. What does this do? It helps the rich get richer, right? Everybody hates that wealth gap. It helps the rich get richer. So let's take a look at this graphic. A study was done, okay? I have the citing at the bottom and in the back of this, all right? A study was done on all registered investment advisors, okay? Not all, but most of them. The median fee, guys, is 1.65%. See it right up there? 1.65% if you go across all asset classes, if you go across all income distribution from people that have 10 grand to invest versus 100 million plus to invest, the average is 1.65. Okay? Very few of them charge 3 or 4%, but they're out there. They're out there. There actually are registered investment advisors that charge 3 and 4%. There are some that charge under 0.5%. But most of the time, they're in this 1 to 1.75% range. And you'll note, the more money you have, the fees drop, right? The more money you have, the fees drop. This is a breakdown of some of the fees that they charge, all right? They just pass them along to you guys. Financial planning fee, investment management fee, platform fees. Yes, they even have trade fees and they pass them along to you. Investment product expenses, all right? If you add all those up, there's your 1.65%. 0.5% financial planning, 0.5% investment management. Ooh, that's a good one, right? 0.2% in platform fees and investment product expenses, 0.45%. Now think about that for a second. If you had a monster account, say you had 50 or $100 million, that's 0.2%. It's pretty expensive for a platform fee, don't you think? Think about it for a second. Break it down. That's pretty damn expensive for a platform fee, okay? Also, your investment advisor can trade and make trades on your behalf. Wow, okay? Wow. So, this is the research study I was referring to. Bob Vere's research study concerningly suggests that even as financial advisors increasingly shift more of their advisory fee value proposition to financial planning and wealth management services, this is the kicker. Advisors are still struggling to demonstrate why financial planning services should command a pricing premium in the marketplace. Are you kidding me? They don't. They don't deserve a price premium. That's the whole point. He's putting it nicely and gently. What he's basically saying is they're a ripoff. They're a ripoff. Now, I'm generalizing here, and I'm going to talk about that in a few minutes as well. But for most people, especially if you have less than $1 million, $2 million, $3 million bucks, a financial advisor is not something you really, really, really need. Okay, now, some people obviously, they lack confidence. They're a little bit scared. They want some advice. I get all of that, okay? But you need to take back the control, guys. You need to take back the control. Keep it simple, stupid. Invest in index funds, total market mutual funds, SPY ETF, VT SAX, VT SMX, okay? And if you don't believe me, this should seal the deal for you. This should seal the deal for you. Okay, remember what a hedge fund charged? 935 grand. Remember what a registered investment advisor charged? 285 grand. That's what a Vanguard mutual fund would have charged you, $36,000. Now remember, that's 0.15. There are two Vanguard funds that I prefer, VTSMX and VT SAX. One of them's 0.04%. I used 0.15 because it's the highest, most expensive fund that I could find in the Vanguard system, at least for total market funds. So this is the most expensive fees that they offer. Most expensive. You can get this down to 0.04%. Do the math on that. What do you be paying? 10 grand? Something like that? So a hedge fund would have made you $2.8 million. If you had just put your money in a total market fund and just walked away, you would have made $1.8, $1.6 million more money. Okay, why in the world would you ever invest with a hedge fund? This is right off Vanguard's website, by the way. Total stock market index, VT-SAX, 0.04%. I used 0.15%, so you would get the worst case scenario. Worst case was $36,000 in fees over an 11-year period. Okay? But realistically, you'd be at 0.04%. So cut that even in 1/3. 12 grand in fees you might pay. 10 grand in fees you might pay. Hello. Wake up, people. Wake up. All right? Stop listening to the BS, because this is what it looks like right in front of you. Wow. 4.4 million versus $2.7 million from a hedge fund. 92% chance your hedge fund underperforms the market. 100% chance your total market fund gets the exact market return. 92% chance your hedge fund underperforms the market. 100% chance the total market fund meets the exact market average. Why? Because it is the market. Now, I don't know about you guys. Do you like those odds? 92% chance they underperform, and you get to pay them a fee to underperform, a massive fee to underperform. Or you could just take a low-cost total market fund and put your money in it and leave it there. And every year invest more, take 20% of your monthly income and add it to the fund, and add it to the fund, and add it to the fund. Okay? I mean, in this scenario, it's a $1.6 million difference. Okay? Morteza, 92% underperformed. So how good are they at hedging? Kind of shoots that theory out of the water, doesn't it? If 92% underperform, how good are they at hedging? And they charge you for it. Oh, and by the way, when the market was down in 2018, hedge funds were down on average 0.5% more than the market. All right? 0.5% more than the market, hedge funds were down. But they do better in volatile times. But they do better when the market's down. It's a joke. It's an absolute laughable joke. Okay? The problem is, the simplicity of this is incredible. The average person isn't doing this. The average person is not doing this. You know what the average person's return was over the last 10 years? I did this in a lecture about 2 months ago, so maybe some of you remember. In a lecture 2 months ago. You know what the average American's return was over the last 10 years? Remember, the market, 15.24% compounded. It was 1.9 or 2.9%. I can't remember exactly. It's 1.9 or 2.9%. Let's give them the benefit and call it 2.9, even though maybe it was 1. Let's just give them the benefit and say it was 2.9. The market average was 15.2. The average person got 2.9. So yeah, compared to the average person, the hedge fund looks like a great deal. But why in the world would you pay more to get less? It's like this. It's like going into a Bentley dealership, paying $300,000 for a Bentley and walking out with a Honda Civic. Seriously, that's exactly what investing in a hedge fund is like. You're walking in, you're handing over a wad of cash to these people, and you're expecting a Bentley in return for your cash, and after 10 years, they hand you over a Honda Civic. Okay? It's a joke. It's an absolute, utter joke. Do you know how many hedge funds there are in the world? 11,000. Do you know how many there were 15 years ago? Less than 2. There are 11,000 hedge funds in the world, and 15 years ago there were less than 2,000. People aren't dumb, meaning hedge fund managers aren't dumb. They see the trend because people are dumb, John. If the average person just got a 2.9% return over the last 10 years in one of the greatest, biggest bullish markets we have ever seen, what does that say about people? People are dumb. No, it's not even feel. They're just dumb. Okay, why? They don't do homework. Think about this for a second. I'm not being mean when I say it. They're dumb. They spend 20, 30, 40 years working their ass off to save this money, and they hand it over to somebody after a 30-minute sales pitch. 20 years of hard work, and in a 30-minute sales pitch, you just handed over your life savings to a hedge fund manager or a registered investment advisor. It's unbelievable. There's way too much information and knowledge out there to fall into that trap and that pitfall. It's unbelievable. I'm leaving this slide up extra long because I want it to sink in for you guys. I don't know about you, but $1.6 million is kind of a lot of money when you started with $1 million. Okay? Maybe ignorant is a more appropriate way to say it. Okay? But my goodness gracious. You're exactly right, Edward. They don't want to take the time to look into something that's going to ensure their future. Help them retire early and retire better. So now, we're not done yet. Buffett versus the hedge funds. So if you just think, oh, Jared's just making this shit all up. He just likes to, be a shock value. It's like Jerry Springer or something like that. Many of you have seen this or heard this, but Warren Buffett in 2008 challenged the hedge fund industry to a duel, so to speak, okay? A duel. And somebody stepped up and said, let's do this. But what a lot of people don't know is there was an actual aggregate of 5 hedge funds that entered this bet. They both bet $1 million each. And at the end, they would donate to charity. It doesn't matter. Winner or loser, you're going to lose $1 million. Basically, both sides are giving up $1 million, win or lose, okay? And they donate it to charity. 5 hedge funds were chosen, and it was the aggregate return of those 5 hedge funds versus Warren Buffett's choice, okay? Versus his choice. You're going to love the next slide. That was Buffett's choice. That was the hedge fund average. You see what he chose? Warren Buffett chose Vanguard's S&P 500 Admiral Fund. That's what he chose. He said, well, keep it simple, stupid. I'm not going to work for this. I'm just going to put it in the market and let the market do all the work. These are the 5 hedge funds. Notice it says Fund A, Fund B, Fund C. Why does it say that, guys? Any idea? I'll give you a hint. It's right below. You can read it. Why does it say Fund A, Fund B, Fund C, Fund D, Fund E? Why? Why does it say that? Because nobody had the balls to put their name out there publicly. Not one of these 5 hedge funds wanted to be named publicly. Why? Why? If you're that good and you're going to charge those kind of fees, put your money where your mouth is. Put your name brand out there and say, we're going to beat Warren. I'm going to take him head on and we're going to beat him. Nope. The funds of funds have not been named publicly. Why? Because they suck. 2.9% after 11 years, or after 9 years is after a 9 year. 2.9% return? Are you kidding me? 2.9%. Now remember, guys, the reason this isn't as huge as the other numbers I just showed you is because this includes 2008. Remember when the market got hammered in 2007 and 8? The point I'm making is they averaged 22%. The Vanguard averaged 85.4. I don't know. I'd rather have 4 times more money. What about you? I'd rather have 4 times more money. I don't know about you. Oh, and yeah, I don't have to pay the ridiculous fees to get it. This was a total, absolute annihilation of the hedge fund industry. It was laughable. One fund did admirably, but I'd still rather have 23% more. I don't know about you. I'd still rather have the 85 instead of the 62. Unbelievable. Unbelievable. This stuff really happens. Oh, but wait. This is the kicker. This is the icing on the cake. Investor who lost Buffett bet says hedge funds could beat the market, but it's not their goal. Oh my goodness gracious. It's not their goal to beat the markets. Hedge funds really don't try to beat the market. Could it happen? Sure. That's an actual quote. OMG. Wow. I mean, I should just drop the mic right here. It's unbelievable. Why in the world would you want to invest with a hedge fund? To underperform and pay more to have it? It's unbelievable. Losing is an absolute decision. You're absolutely right. It's not their goal. I want you to really stir on that for a second. It's not our goal. We don't really try to beat the market. Well, then what the hell are you trying to do? Oh, that's right. Beat that moving benchmark that you sell people on. Oh, we beat our benchmark 5 years in a row. Well, did you beat the market? No. It's all that really matters. Okay? Unbelievable. So, as we wind this up, all right, this is just from 2009 to 2018. Hedge funds had an average annualized return of 6%, according to data provider Hedge Fund Research. Less than half, no, it's not Groundhog's Day, of the S&P 500's 15.8% annual return. In 2018, hedge funds returned minus 4.07% versus the total market fund minus, so they beat the market in 1 year out of 10. Oh, wow. But overall, they averaged 6% compounded, and the market was 15.8% compounded. Wow, I can't wait to pay these guys lots and lots of fees. Guys, take a look at this for a second. This is an important slide. 1926 to 2019. This is the stock market return, okay? Year by year stock market return, okay? So let's just take the logic for a second. Let's just say we're going to give hedge funds the benefit of the doubt. And let's say they do beat the market on down years, or they do beat the market in some volatile times. How often do they get an opportunity to beat the market? Well, look at the red dots on here. There's one right there. There's one right there. There's 3 years in a row right there. There's one right there. So over the last 40 years, okay, 40, the market is up, as in positive, 33 out of 40 years. 33 out of the past 40 years, the market is positive. That's an 82% win rate. The market is positive, net positive, 82% of the time over the past 40 years. So that means if hedge funds are right that they make more money in down markets, they only have 18% of the time to beat the 82% of the time. Does that make sense to you? They have 7 years out of 40 to beat the other 33 years. Good luck with that. Good luck with that. The numbers just don't make sense in any way, shape, or form. And here's the worst part, guys. This is the worst part. We just talked about hedge fund fees being 900 grand. Well, what if they charge nothing in fees? It's still not worth putting your money with them because they don't outperform the market 92% of the time. So even if they were free, you wouldn't want to put your money with them because they almost never, 92% of the time, they never outperform the market. Now, the question now becomes, well, what about Ray Dalio and Stephen Cohen and all of these other very wealthy hedge fund managers? Are they all scam artist assholes? No. Those guys that are top 5, 6, 7 on that list, top 10, top 15 on that list, they deserve to be there. Most of the time, they crush the market. All right, I'll go back to this gentleman because he's probably one of the least known for people outside of the industry, but he's unbelievably successful. This guy right here. Okay? Do you guys know who this is? Somebody mentioned it earlier. I'll give you a hint. He's on top of the list. And what list am I referring to? This list. This is James Simons. Okay? He deserves to be there. Renaissance is a quant fund, and it outperforms the market so unbelievably, it's not even funny. They're the gold standard. All right? I'm not saying that Bridgewater sucks or Citadel. They're all awesome. So you're saying to yourself, I know what's coming. I'm inside your head right now. Well, geez, Jared, no problem. I'll just invest in one of these funds. Is your name Bill Gates? Is your name Warren Buffett? Do you know what kind of money it takes to get into these funds? If and when they open? Almost all of them are closed to outside money. Almost all of them are closed to outside money. So of the 11,000 hedge funds, 92% of them, okay, 11, what would that be? Let's see, times 0.92. So that means 10,120 of those funds underperform. So you might have 1,000 funds out there that slightly outperform, but the best of the best, like the top 10, 20, 30 funds out there, you're not getting into them. You're not going to see these kinds of returns that these guys are seeing. So then you think to yourself, well, where does that leave me? If I'm very, very hard pressed, like literally finding a needle in a haystack to be able to, one, get into a fund that outperforms, or I should say, find a fund that outperforms, find a fund, and then be able to even get into it. A lot of hedge funds require you to be at least liquid to $1 or $2 million net worth, not including your primary residence. A lot of hedge funds are that way. Okay? Well, that's good for most of you guys because that'll keep you from investing in bad things. But my point is even if you found a fund that outperformed, it's very unlikely they even offer outside money, meaning they're open to outside money. And if they did, it's probably more money than you have. It's probably more money than you have. Okay? So why don't you just keep it simple, stupid, and do what Warren Buffett did and be a smart person, pay nothing in fees or very little in fees, and put it in a total market fund and walk away. Every paycheck you take 10 or 20%, put it in there every month, every month, every month, every month. 100% stocks. About 10 years before your retirement, rebalance your portfolio. Rebalance your portfolio. But until then, just let it ride, okay? Let it ride. You don't want to be a part of this, guys. I'm telling you. You don't want to be a part of this. I'm not even going to talk about it, all right? So, I just mentioned all this. So the odds that you're going to find a fund that you can actually get into and that beats the market, slim to none. Why waste your time doing it? Why waste your time doing it? When at the end of the day, the numbers look like this. And that even assumes you find a fund that can beat the market or meet the market average. All right, so when I said hedge funds are a scam, I wasn't too far off, was I? They're not all a scam, but the vast majority of them are a joke. Okay, they're not trying to beat the market, and they're going to sell you on something else. Well, we're a conservative fund, so we're not going to beat the market, but we're not going to lose as badly when the market goes down either. Well, I just want the market average or better. Can you get me that over 10 years? No. They'll tell you that. No. But we're going to protect your money in volatile times. So, the last thing I'll leave you with is this. Who would put their money in a hedge fund? Or who would put their money with a wealth manager or registered investment advisor? Well, the people that have a lot of money, tens of millions, hundreds of millions of dollars, will be able to find one of those top funds, 10, 20, top 30 fund, and they'll probably be okay. But one, you don't have the money to get into those funds. So your odds of finding a fund that has a low entry fee and is open to outside money and beats the market are slim to none. Okay? So it's better for you to put your money in a total market fund. Now, what about registered investment advisor? Same. If you have less than $5 or $10 million, you really don't need a registered investment advisor or a wealth manager. If you have more than that, then yeah, you probably need that because you're going to want a slightly more diversified portfolio. Maybe you're trying to set up trusts for your kids or you have estate planning. A wealth manager can help you do those things. Or maybe you have a home office, all right? But for people with like $0 to $5 million, just put your money in the market and walk away. Put your money in the market and walk away. And 10 years before retirement, rebalance your portfolio. It's that simple. It doesn't have to be so complicated. The reason I'm commenting is you have more money. Once you start getting into the higher tax brackets, guys, more money, you're going to want to figure out more tax advisable investments, so to speak, how to protect your money, how you want to distribute your money to your family if you have kids that you want to leave it to. All of those things become serious considerations. But until you get to that point, it's not that big of a deal, okay? It's not that big of a deal. It should matter to you, Patricia, because you want them to be fiduciary. That means they have your best interest in mind. Does that always mean they'll do the right thing? Not necessarily, but they're supposed to. Like a doctor taking the Hippocratic oath. They're supposed to do the right thing, but ask Michael Jackson's doctor how that works. Money seems to talk. Okay? All right. That'll do it for this week's lecture. I told you it'd be a little different. I hope that you guys enjoyed it. I hope you learned a little something. It wasn't specifically related to trading, but I think it was useful and helpful because I've been getting quite a few emails about investments lately because I'm doing a wealth building course coming up. We will have a section, or I should say a chapter, on hedge funds and investment advisors, et cetera, and so forth. But I think for a lot of you, it's probably a bit of an eye-opening experience seeing really what the truth of the matter is out there, okay? Part of me wanting to do this was also because I have a really good friend that's a hedge fund manager, and he's like, the fees we charge, I'm using his own words, they're disgusting, but people keep coming. So why wouldn't you? Seriously, why wouldn't you? They look at it as we're not losing money, we're making people money, but they always change the benchmark. Well, the benchmark should be the market for everybody. Okay, it should be, at least for most people. There's a small percentage of people, maybe it's a little bit different. All right, so that will do it for this week's lecture. I hope you guys enjoyed it. We'll get back at it again next week.